Welcome back to the Deep Dive. Today, we're digging into a really fascinating document, Giverny Capital's 2009 Annual Letter to Partners. Our mission, as always, is to pull out the key insights, make them easy to grasp, and basically give you a shortcut to understanding how they navigated, well, one of the craziest financial years we've seen recently.
And that 2009 letter, it's just so compelling. It was written, right after the 2008 crash.
Right in the thick of it.
Exactly. So you get these raw, real-time feelings about investor sentiment, market conditions. It's immediate.
Yeah.
And even the cover art, Girl on a Wire, it just perfectly captures that feeling. Investors walking this tightrope over an economic ravine. Really sums up the mood of 2009.
Let's really try and put ourselves there. Imagine you're an investor. It's February 2009. What was Giverny actually facing? Markets were just free-falling.
Absolutely free-falling. To levels not seen since, 1997?
Wow. And yet, in their previous letter, written right then in Feb. 09, they called it the opportunity of a generation. That seems incredibly bold.
It was bold. 2009 was described as possibly the worst economic year since the Great Depression. Seriously.
Since the 30s.
Yeah. Aggregate company revenues across the board dropped 20%.
They're on 20%.
There was real talk, serious talk about nationalizing U.S. banks. The entire Irish banking system just collapsed.
Right.
And the BRIC markets, Brazil, Russia, India, China, they tumbled between 55 and 75%.
Just staggering numbers.
The pessimism was just overwhelming. You had experienced investors sitting on huge piles of cash.
Doing nothing.
Well, earning nothing. U.S. Treasury bonds were near zero, even went negative for a bit, but people were just too scared to invest.
Okay, so amidst that climate, Giverny sees companies trading at, a third, sometimes a quarter of their intrinsic value?
That's what they thought. Incredible bargains, theoretically.
And they didn't just see it, they acted. They invested every dollar they could find, including their own money. That takes some serious conviction, doesn't it? Not just talking the talk.
It really does. It's easy to say buy the dip looking back, but when you're in it and the whole system feels like it might actually break, that's different.
So what happened? Did the bet pay off?
Well, yeah, the rebound was pretty significant. Giverny's holdings went up nearly 28% for the year.
Okay.
Now, adjusted to Canadian dollars, that was about 12%. It was actually slightly less than their benchmark index that year.
Oh, interesting. Why was that?
Mainly due to three big holdings kind of lagging a bit. Berkshire Hathaway, MTY Food, and Notori. But, and this is crucial, Giverny points out that those companies still grew their underlying intrinsic value during that time.
Ah, so the businesses themselves were getting stronger, even if the stock price didn't fully reflect it immediately.
Exactly. And the big lesson Giverny took from it all was powerful. Capitalism survived, the system didn't collapse, and basically those who were courageous enough to hold on to their shares, they were rewarded.
It really underscores that long-term view, even when things look absolutely dire. Which kind of leads us perfectly into the, let's say, timeless wisdom Giverny shared in the letter, drawing from this whole experience.
Right. They really believe in reading history, keeping current events in perspective.
They quoted Lincoln, didn't they?
They did, from 1859. And this, too, shall pass away. How much it expresses, how chastening in the hour of pride, how consoling in the depths of affliction. Powerful stuff.
It speaks to that cyclical nature, right? Economies expand, they contract.
Exactly. But the overall trend, long-term, is progress. Civilization generally moves towards a higher standard of living, despite the bumps.
And the letter points out the danger of debt in the good times, the expansions.
Yeah, and how during the contractions, everyone kind of gets punished, even the careful ones.
So the takeaway is, if you can afford to wait.
You need to remain emotionally immune to the market drops. Because eventually, markets do recover and hit new highs. You just have to ride it out.
Giverny also seemed pretty skeptical about economists trying to predict short-term moves. They compared them to, ancient scientists.
Yeah, like the ones who thought everything was just earth, water, air, and fire. A bit simplistic.
Oh, so what was their point there?
That predicting markets isn't just about a few indicators. It involves tracking, as they put it, several 100 million human beings.
The human element. Psychology, fear, and greed.
Precisely. Way too complex for simple formulas. It's not just math.
Okay, so building on that, what were the key principles Giverny really hammered home coming out of the crisis? Let's unpack this.
Well, first, that simple truth. Everything that cannot rise forever will someday stop.
Right. They listed examples: derivative speculation, tech stocks back in 2000, U.S. housing in 2005, Dubai, oil prices. It applies everywhere.
And the natural cycle of businesses, too. Some
Yeah.
die off, new ones are born. It's constant change.
And the ones that die off, the bankruptcies.
Yeah.
Any common theme?
Overwhelmingly. Too much debt. The
Ah,
survivors. They tend to have solid balance sheets and with leadership that is prudent, trustworthy, and devoted. Seems obvious, maybe, but crucial.
it's the fundamentals. They also brought up Buffett's rule about being prepared for a 50% drop.
Yeah, basically accept that it'll probably happen at least once in your investing lifetime. Don't panic when it does.
And the danger of investing on margin.
Extreme danger, especially when markets get irrational. You can wipe out decades of gains in a flash.
They call derivatives plus leverage an explosive cocktail.
A very apt description. But then there's the good news, right? From Ben Graham.
The father of value investing.
That in the long run, the market does tend to reflect intrinsic value. So staying calm, being rational, that's the most important quality.
Calm and rationality. Easier said than done sometimes.
Tell me about it.
But this all feeds into Giverny's core approach, doesn't it? Investing for the long term in high-quality companies purchased at attractive valuations.
Investing in companies that will survive the crises of our civilization. That's their goal.
And they quote Graham again from The Intelligent Investor about having courage.
Yes, a fantastic quote from 1949. Have the courage of your knowledge and experience. If you have formed a conclusion from the facts, and if you know your judgment is sound, act on it, even though others may hesitate or differ.
Because you're right, based on your data and reasoning, not because others agree.
Exactly. It's about conviction in your own analysis, not following the herd.
So, shifting gears a bit, 2009 wasn't just a single bad year, it was the end of a pretty rough decade, right?
Yeah. The letter points out the decade actually started with extreme overvaluations, especially tech stocks. Remember the NASDAQ hitting 5,000 in March 2000?
Vaguely terrifying memory, yes.
And get this, the entire decade, 2000 to 2009, was the only decade in 100 years, apart from the 1930s Depression era, where the S&P 500 actually lost value.
The only one besides the Great Depression.
Wow. Really shows that constant change Giverny talks about. You have this corporate cemetery of companies that vanished, but also the birth of titans like Google, Apple, Amazon.
Right, and globally, returns were pretty weak that decade.
Modest gains, yeah. And for Canadian investors looking at U.S. stocks, it was even worse because the Canadian dollar, the loonie, got much stronger.
Ah, the currency effect.
Right. It climbed from about 69 U.S. cents to 95 cents over the decade. That knocked off like 3% per year from U.S. returns for Canadians.
Ouch. But Canada itself did okay?
Canada was a bit of a bright spot, yeah. About 5.6% annual return for its market. Though the letter does note Canada lagged a bit in productivity and innovation in knowledge industries compared to others.
Okay, and here's where Giverny raises a specific flag.
Hmm.
The flavor of the day they warned about back in 2009, Canadian housing.
Yes. They quote Buffett. There is no greater sedative than money easily made.
So what was the issue they saw in Canadian real estate?
Well, they acknowledged it had been a source of huge wealth since 2000, but they also reminded people that for the decade before that, prices hadn't moved at all.
Right, stagnant.
So they saw this price boom as having two parts. First, a reasonable catch-up based on actual economics fundamentals,
Okay.
but then a speculative second phase where prices kind of detached from those fundamentals and just kept going up because, well, they kept going up.
And Canada hadn't had the big correction that the U.S. and Europe saw.
Nope. The U.S. market was down 30%. Canada avoided that. And Giverny suggested this might have been seemingly more rooted in politics rather than economics.
Oh, so, politics.
They pointed to the federal government really pushing banks to keep lending, using CMHC, the Canadian Mortgage and Housing Corporation, to backstop it all, mortgage insurance.
Got it. So the government was essentially encouraging the lending that kept prices high.
That was Giverny's take. And the data they presented was, well, concerning. The average Canadian home price hit $333,000 in 2009.
Okay.
Relative to GDP per person, that was an 8-to-1 ratio. Historically, it had averaged more like 6-to-1.
So prices were maybe a third higher than the historical norm.
Especially out west.
Roughly, yeah. And the amount of mortgages insured and securitized by CMHC just exploded. Went from 165 billion Canadian dollars in 2007 to 373 billion in 2009. Wow, more than doubled in 2 years. That sounds like a big potential liability for the government.
A significant potential liability, as Giverny put it.
So let's recap those ingredients Giverny saw. Record high prices relative to income, rock bottom mortgage rates, some at 2%.
Yep, incredibly low rates, making payments seem affordable.
Easy borrowing backed by CMHC's own financial cushion shrinking.
Its equity to assets ratio dropped quite a bit, yeah.
And maybe the most dangerous part, buyers believing prices would never drop, thinking real estate was risk-free.
Which brings us right back to that core idea. Real risks are at their apex when they're perceived to be at their low point.
When everyone thinks something is safe, that's when it's often riskiest.
Exactly. So while Giverny acknowledged homeownership has benefits beyond money and prices probably rise long term,
But
they concluded back then that all the ingredients are in place for potentially several years of difficulty as prices are readjusted. A clear warning sign.
a potential party that had gone on too long. Okay, so given all this turbulence and these specific concerns, what did Giverny actually own? How did their portfolio holdings weather the storm?
They quote Charles de Gaulle, "Character, the virtue of hard times." And they said while lots of companies struggled with earnings that year,
Understandably.
the majority of their holdings actually continued to widen their competitive moats. They got stronger relative to competitors.
Can you give us some examples from the letter?
Sure. Wells Fargo. They bought Wachovia during the crisis, basically doubled their size pretty profitably. Giverny thought the stock could hit $60. Nitori Co., the Japanese furniture retailer, sales up 17%, profits up 30%, but the stock price didn't budge.
Weird. Market mispricing.
Looked like it. Then Disney. Bob Iger had just bought Marvel. Great synergy. Plus, as they say, Mickey has no agent.
True.
Disney stock actually fell to $16 in March '09. Just 8 times earnings. Giverny saw it as a rare bargain and jumped in.
8 times earnings for Disney.
Wow. Yeah. Microsoft finished '09 strong with Windows 7, record sales, good profit growth, still looked cheap at 11 times earnings, and had tons of cash, $43 billion. And one more, MTY Food Group in Canada, restaurant franchisor. Had an exceptional year, revenues up over 50%, earnings per share up 32%, mostly from acquisitions.
What was special about them?
Giverny liked that it was kind of unexciting, didn't attract much competition, great returns, no debt, brilliant management, just a solid under-the-radar compounder.
It's fascinating to see the actual companies, but what really stands out is Giverny's honesty about their mistakes, right? The mistake du jour section.
Oh, absolutely. Their 5-year post-mortem analysis, too. They really emphasize learning from errors.
And they make that point that sometimes not buying something, an error of omission, can be more costly than buying something that goes wrong.
Definitely. It's harder to track, but often true.
So what were some of the mistakes they highlighted?
Okay, so in their 2004 post-mortem review, they talked about selling Yahoo at $8, then went to $38. The lesson: tech advantages can be fleeting, and judging investments takes years. Time is the most objective judge.
Okay. What about the 2009 medals for mistakes? Bronze.
Bronze medal went to BYD, the Chinese battery and car maker. Charlie Munger was raving about the CEO, Wang Chuanfu.
Calling him like Edison and Jack Welch combined.
Yeah. Giverny loved the innovation, the electric car potential, but they hesitated because the valuation seemed high, like 30 times PE. Stock went up 400% in a year.
Whoa.
The lesson there was about the artistic side of investing. Sometimes you make a leap of faith on an exceptional person, even if the numbers look stretched.
Interesting. Silver medal.
Silver was TJX Companies, the discount retailer like TJ Maxx or Marshalls. Giverny knew they'd do well in a recession.
Makes sense.
And they did. Earnings per share soared 48% in 2009. The stock had previously lost half its value, down to like 10 times PE. Looked cheap.
But Giverny didn't buy.
They remained motionless, and then the stock doubled.
So the lesson.
If a stock doubles and it's still looking undervalued, it must have been incredibly cheap before. It highlights how much value can be missed.
Okay, and the gold medal mistake of 2009.
This one was Cabela's, the big outdoor retailer. Its stock crashed from $28 down to $4 in 2008.
$4.
Yeah. At $4 or $5, it was trading at a price-earnings ratio of just 4. 4.
Yeah.
That implies like a 25% annual return, even if the company never grew again.
That seems ridiculously cheap for a market leader.
Giverny called it a rare event, high-quality business, dirt cheap. They admitted they missed a big opportunity. They said they certainly could have sold another stock, trading at half of its intrinsic value to buy Cabela's that was trading at 1/5 of its value.
So swap a pretty good bargain for an absolutely incredible one.
Exactly. Their lesson: selling a 50-cent dollar to buy a 20-cent dollar makes a lot of sense. Optimize your portfolio for the best values. Cabela's stock quickly shot up to $16.
Wow. That honesty is really valuable. Okay, to wrap up this deep dive, Giverny finished the letter talking about Warren Buffett's big move in 2009.
Right. The biggest wager. Berkshire Hathaway buying the rest of Burlington Northern Santa Fe, the railroad, BNSF, a $34 billion deal.
And Buffett's quote about it.
It's classic Buffett. Most important of all, however, it's an all-NN wager on the economic future of the United States. I love these bets.
An all-in bet on America.
Yeah, but Giverny points out Buffett's no gambler. He's just following his own rule.
Be fearful when others are greedy.
And greedy when others are fearful, buying a massive essential asset during peak pessimism. Giverny echoed that optimism for their own companies, too, expecting the next few years to be quite rewarding.
And they ended by reminding you, the listener, their partners, that they're committed to being outstanding stewards of your capital.
It really is a masterclass, that letter, not just in investing mechanics, but in the psychology, the resilience needed in those extreme moments.
So reflecting on all this,
Maybe ask yourself, how could cultivating that courage of your knowledge and experience that Graham talked about change how you view market swings today? And maybe are you overlooking opportunities by not embracing that artistic side of investing sometimes, making that leap of faith when your data and reasoning really line up, even if it feels uncomfortable? Something to think about.